Hi there, welcome to Funding by Alex. My name is Alex, and today I would like to talk to you about sustainable growth. So, if you were wondering, yes, there is a formula. So, the formula for sustainable growth is return on equity times 1 minus dividend payout ratio. So, minus the dividends that are paid out, meaning the money that flows out of the company, which can't be reinvested in growth. Normally, you would retain earnings and reinvest in growth. In this case, every dollar you make, you put back into the company to grow the business. So, this is actually the formula before you have to raise another round of debt or, let's say, equity. So this is the balance that a lot of companies are struggling with. So if you look at growth versus dividends, or you say on the stock market investors, you have value investors and growth investors. So value investors normally are investors who are looking for companies that are undervalued. So in essence, normally also dividend investors, but I mean value investors normally try to buy cheap companies. The issue with this is like there are companies that grow. It's difficult to see how much a company will grow or what it's worth in the end. So they can't really understand the growth curve of these companies. This is also why tech stocks are very unpredictable. So tech stocks normally are high growth stocks, meaning that value investors are normally not that interested in it. So you have this curve where on one hand you have growth investors, so they need growth. Value investors, okay, it's not cheap enough. So in essence, if you sit in the middle, so you're not interesting for value investors or growth investors, basically on either side of the spectrum, nothing will happen. So normally these companies are stagnant in terms of the share price if it goes for public companies. Now the same thing goes for investors, private investors, basically. So there are some companies that actually struggle with the fact that there are activist investors basically that are forcing the company to pay dividends. So hey, I've invested in this company, I am forcing you to pay out. Now this is the reason why in the previous formula you are deducting dividends in order to calculate the sustainable growth rate. So sustainable growth rate is very important to model. Also when you are going to do, let's say, your projections for the coming years, and making your deck basically for investors. So this also links to growth in startups. So startups normally they start with growth in mind. So you need to grow fast in order to interest investors. If the growth is not interesting enough, so let's say too low, too conservative, investors will shy away because they say, okay, I put in $1 and I don't get enough back on that dollar. So the projections are not sexy enough for me basically to invest my money. So this is what you call the hockey stick growth. The hockey stick growth. The hockey stick, of course, is a long stick and it has a sharp rise at the end, so a sharp edge at the end. So this is the way you would have to look at growth. So where you invest in the company is not growing maybe initially, but you're looking at invested capital. As soon as they are raising capital, that this hockey stick growth has to go there with the same amount of capital invested that the growth is actually materializing. So this is also scaling without too many additional resources. I'm stating it here maybe a bit simplistic, but in essence what you want is with the capital you raise, you want to have an incremental growth curve. So, in essence, not constantly, oh, I need to grow, therefore I need more money, because eventually you would like to leverage this capital in order to make growth a bit easier and faster. So hypergrowth, even though it can be something that is applauded and very interesting, but hypergrowth is both good and bad. So good meaning like you can get from 0 to 100 very fast. That this can also be that you're very successful in the business and you can run as fast as you can run basically and grow and capture the market very quickly. The bad thing is, of course, like both it makes some investors very nervous. You say, look, okay, I'm projecting hypergrowth, and not that you achieve it, but you're projecting it. That is a red flag when total addressable market, for example, is projected already at like 90 or 100% of the total market. So you're looking at how much you want to capture of the market that is there. That is where you are modeling growth. So growth always starts with modeling revenue. So revenue is very important in order to understand like where's the company going. Normally, everything else is a percentage of revenue. When you look at cost, look at budgets, etc. So modeling revenue is where the sustainable growth formula comes into play. So if you are talking about a company looking to make a certain projection for the future, you have for example, year one, you start with $100,000. Year two, you want to go to $1 million. Year three to $10 million. Now, this is constant, hypergrowth. Could be hypergrowth, could be very sustainable growth. Depends a little bit on, various factors. It usually goes down to, a function of the units you're going to sell times the pricing. So pricing normally would go down as soon as competitors are entering the market. You basically are taking a price hit. So it rarely becomes thicker, the margins. It usually comes thinner rather than increasing in that sense. So these are the things that sound and healthy financial statements or financial projections need to encompass. If you are an investor and you're looking at this, it's definitely a red flag. And I'm looking more at this from a startup founder perspective. And this is actually a video series that I am making to make startup founders or aspiring startup founders a bit more, give them a bit more information about what to expect. So this is actually where you start. So modeling revenue, because in the end, you can have the greatest idea, you can have the most wonderful mission and vision and all these things, but in the end, it comes down to what is your revenue model? Where is the revenue coming from? And if you don't have revenue projections that are materializing right away, you of course have things like users, users of your product, which can also have a growth projection, obviously, and therefore also a sustainable growth model. So how many users are there in the world? Now, Facebook is a good example of a company that grew exponentially, and the users were very quickly to adopt Facebook. That's a very rare case. You can't model like, okay, Facebook did this, therefore I do that as well. So Facebook was a very unique case in a time also when this thing just took off for them. Most users actually were very intensive users. That is, in this day and age, until the next big thing comes along, the next window opens, it's very rare to come up with something which is, heavy users and exponential user growth. Hyper growth on users is another thing. So, like I mentioned, revenue or usage is another metric basically, but it always starts with revenue when it comes to investors, because in the end they need to know, okay, these users, even if you not looking at revenue initially, how much will these users make? What can I beat out of these users in terms of lifetime value? And that is basically how these investors are making their assumptions about the company. Now, growth is also this is something I haven't put on paper here, but growth actually is also something that people can predict. If the management team has proven that they led previous startups to massive growth, like you have a track record basically, that's easier to understand. Okay, this guy has done, was the CEO of this company, has exited as a founder and is starting a new business, and he did it before. Therefore, these assumptions are a bit more believable than Joe Nobody, who is actually starting from zero and still has to prove it all. Can be similar, can be the same. You have very accomplished people who also are maybe falling flat on their face once in a while, but failure is also a way to learn in life. So in that sense, I'm not saying that is something to mock or laugh about. It's just a matter of people with a track record usually, when they make a claim like this, they don't have to back it up as much as when you are a nobody. That's the thing. So I'm stopping here with regards to the growth in startups. So startups, like I'm a startup advisor myself, so I've done several of these revenue modeling sessions in the past year alone. In the end, it all comes down to, can you in the end deliver this growth that you are promising? So it has to be reasonable. It has to be sustainable. Thank you for watching this video. Please don't forget to like and subscribe, and I hope to see you in the next video. Thank you for watching.